How is pre-money valuation calculated before Series A funding? Imagine you're about to pitch your startup to investors and want to know what your company is worth before they put in their money. That's where pre-money valuation comes into play. It's a key number that helps decide how much ownership each party will have after the funding round. But how do you actually figure out this number? Pre-money valuation is the estimated value of your startup before you receive new investment in a Series A funding round. It shows what your company is worth without the fresh cash coming in. This valuation is important because it sets the stage for how much of your company the investors will own once they invest. There are a few common ways to calculate pre-money valuation. One simple method looks at your company's balance sheet. You take the total assets minus liabilities, which gives you the equity value. But this can be tricky if your startup has a lot of intangible assets like intellectual property or future revenue projections that aren't on the balance sheet. Another popular approach is to use a third-party valuation called a 409A valuation. This is an independent assessment that estimates your company's fair market value, especially useful if your startup doesn't have much revenue yet. It helps ensure your valuation is based on objective data. Many founders and investors also use a comparison method. They look at similar startups in your industry and region that recently raised money. They then adjust the average valuation based on your company's strengths or weaknesses. Factors like your management team, product quality, market size, and sales channels are all taken into account. Investors tend to put a lot of weight on the team, since a strong team can often turn a good idea into a successful business. Market conditions also influence pre-money valuation. If the market is hot and investors are eager to put money into startups, valuations tend to be higher. Conversely, in a slow market, valuations might be lower. Once you have a pre-money valuation, you add the amount of new funding to get the post-money valuation. For example, if your startup is valued at $10 million before the round and you raise $2.5 million, your post-money valuation becomes $12.5 million. The investor's ownership percentage is then calculated by dividing their investment by this post-money number. Understanding how to calculate pre-money valuation helps you negotiate better terms with investors. It also gives you a clearer picture of your company's worth and how much ownership you might retain after the funding. To prepare, gather your financial data, research comparable startups, and consider your growth potential. This way, you can approach your Series A funding round with confidence.